a lot of the time, the cost prices of inventory don't just stay the same, they actually change. And this can be due to higher demand or suppliers having sales. And when there are different cost prices, it has to be listed separately in the inventory card. So let's go back to our example from before. We still have the exact same opening balance of inventory on hand, so we still have 20 extra large blue shirts at $10 per shirt and a total opening balance of $200. This time though, our first transaction has changed slightly. So the business has purchased 25 shirts for $15 per shirt. And you can see that this is a change in cost price. It has increased, the cost price of these extra large blue shirts has increased from $10 per shirt to $15 per shirt. And this just might be the supplier has decided to increase their selling prices because there's a high demand for their extra large blue shirts. It's a popular item. So they've decided to start charging more for extra large blue shirts. And as a result, you as the business you can either choose to keep buying from that same supplier and just cop the extra cost price, or you can decide to look for a cheaper supplier. Those are pretty much your only options. But in this case, obviously, the business has chosen to keep purchasing from the supplier, even with the increased price of the inventory. Okay, and now this is how we enter that transaction into the inventory card. So under date, similarly to what we did before, under date is February 4th, and under details is invoice 101. That's the exact same as the last time we did this example. The transaction still goes in the in column because it's a purchase, so inventory is coming into the business. The quantity, cost, and total of the inventory coming in is recorded, which is 25 shirts at $15 per shirt and a total of $375. But the main difference is under the balance column. So there are two lines for the balance of inventory on hand. The two cost prices have been listed separately. So we have kind of two batches of inventory. So we have the first batch that we already had on hand, which is 20 extra large blue shirts that were valued at $10 per shirt for a total of $200. And we have the second batch of inventory, which is 25 shirts at $15 per shirt for a total of $375. Okay, so when cost prices are changing, there are two methods that we can use to allocate the cost of inventory leaving the business. The first one is identified cost, and the second one is first in, first out, or FIFO. If a business chooses identified cost, every single item that the business has on hand, so every single individual physical product that the business has in their store that they're intending to sell, must be labeled in some way that is identifiable. So probably the most common example of this that you might have seen in stores is having tags on certain items, or even having stickers that have barcodes. So when inventory has barcodes, the business can identify the exact cost price of that specific physical product whenever an item is sold. So for example, every time they sell an extra large blue shirt, they will take the shirt and then the cashier will scan the barcode on the tag, and then that barcode will tell the computer system of the business that this extra large blue shirt cost $15. And so that particular sale, you'll record the cost price at $15 instead of trying to guess the cost price, because obviously in your inventory card you have multiple batches of inventory, so you're not too sure about which batch. But if you have barcodes, you can actually accurately tell what the cost price is. And for identified cost questions, you will be told the cost price as part of the question. So you can see an example of this where a sale has occurred and the question is telling us the exact cost price of the inventory. So here's an example. It says on the 4th of February, the business has sold 5 shirts for 165, and it says the cost price of the 5 shirts was $15 per shirt. So when we have a question, an inventory question that is where the business is using the identified cost method, it's a little bit easier for you guys because the question will just straight up tell you the cost price of the item that is being sold, which is a lot easier for when you have to record in the inventory card. And obviously, identified cost as a method is very, very accurate. And so most of the time it's preferred because you're going to have your records and your reports being as accurate as possible, right? Because you're using labeling and barcodes to ensure that when you're selling a product, you're recording the correct cost price of that product. However, even though the method is very, very accurate, sometimes it's just not possible for the business to use identified cost. So, for example, if a business has inventory that's really, really small, so for example, a hardware store, right? Like, for example, like Bunnings, but obviously a smaller version of Bunnings. Bunnings is a huge, huge store. Think of like a small business that sells like hardware, like specifically they sell like drills and drill bits, and they sell like nails and screws and like nuts and bolts. So obviously like nails and screws are really, really small. They're really, really tiny and fiddly. And so, sometimes like they're so small, it's just impossible to put a sticker or a tag on every single individual nail. Or maybe it is possible. Like, technically, you could get someone to sit there and sort through like 5,000 screws and stick a tag to each individual screw. Um, but is that really ideal for the business? So sometimes, even if it is possible for the business to individually label every single item of inventory, the business owner might decide that it's not worth the time and cost because obviously, when a business decides to use the identified cost method and they decide, okay, we're gonna add a tag and a sticker to every single item of inventory that we're selling, that's not just gonna magically happen. They have to, get one of their employees to sit and add a tag or add a sticker on to their inventory, and that will you have to pay that employee for those hours where they're just sitting there sticking tags and labels onto your inventory, um, which sometimes, depending on your range of inventory, how much inventory you have, sometimes that could take hours and hours and hours worth of time. And the business might decide, that time and the cost that you're putting into paying that employee to sit there and label these inventory items, that time and cost could be put into other areas of the business, or that employee could be doing something else that's much more beneficial to the business instead of sitting there for like 7 hours just adding tags and labels onto inventory. And so the business owner makes the executive decision that it's just not worth it to use identified cost. So like I said, in an ideal world, every single business would be able to use identified cost because it's the most accurate method. You're going to have the specific cost price of every single product that you're selling, which is, way more accurate. But the problem with identified cost is it's either sometimes not possible, and in other cases, it's just not practical. It's just not it's just not worth it for the business. So at the end of the day, it ultimately is up to the business owner about whether they think identified cost is worth implementing. So, sometimes, a business really shouldn't be using identified cost because it's taking, them hours and hours and hours to individually label every single item of inventory. But if the business owner wants, a really, really accurate inventory card, and they want to know, like, 100% without a doubt what the cost of sales and cost of goods sold is, then that's up to the business owner. It's their prerogative to decide whether they want to use identified cost. But in the case where identified cost isn't used, either because it's not possible or it's not worth it, we will instead use first in, first out, or FIFO. Okay, before I even tell you what FIFO is, the most important thing to remember with FIFO is that it's an assumption. So with identified cost isn't an assumption. Identified cost is just you put a sticker on every single item of inventory, and then as it's sold, you scan the sticker, or you scan the barcode, or you scan the tag, or you scan the label, or whatever, and it'll tell you on the screen, this shirt cost this much money. This was the cost price of this shirt, and you write that down in your inventory card. With first in, first out, there's nothing like that. It is literally just an assumption that we're making. So when we use first in, first out, we assume that the inventory that was purchased first is sold first. This doesn't mean that this is what actually happens, but this is what we assume happens. So probably the biggest mistake that people make with questions like this, with cost allocation methods, is they think that if a business uses first in, first out, that means that all of their old inventory is sold first. That's not true. All it means is, from the standpoint of us, the accountant, we are assuming, and because we are assuming that, the report will reflect that assumption that any inventory that is purchased first will be sold first. So basically, the older inventory that has been on hand for longer is being assumed to have been sold first. So when there's a question that involves first in, first out, the cost price of the inventory will not be included in the question, and it's up to you to correctly select the correct cost price under the rules of first in, first out. So you can see in the example, the cost price of the sale is not given to us at all. So it says on Feb 4th, the business sold 5 extra large shirts, and it says the selling price. And then you would have to look at the inventory card and what has already been recorded, and according to that, you would have to use the first in, first out assumption to assume what the cost price of this transaction is. So hopefully that makes sense. Okay, FIFO can definitely be a bit confusing at times, but if you remember these rules, you should be fine. So, when there's a sale of inventory, we use the oldest cost price in the balance column, which is the oldest cost price on hand. When there is an inventory gain, we use the latest cost price in the in column, so whatever the last cost price in the in column is. When there is an inventory loss, we use the oldest cost price in the balance column, which is the oldest cost price on hand. And when there's a sales return, we use the latest cost price in the out column. So that can be a bit confusing, but if you just literally just memorize those 4 rules, I promise you first in, first out will be a lot easier to wrap your head around, and you'll be getting a lot more marks on questions that involve first in, first out. Okay, this is our last quiz question, so I'll give you a few minutes because it's a bit of a big one. So the business has shirts on hand at different cost prices. 20 of the shirts have a cost price of $10 per shirt, and 25 of the shirts have a cost price of $15 per shirt. The business then sells 15 of the shirts. Using the first in, first out assumption, what is the cost price of the 15 shares sold? So I'm going to give you 4 minutes time just to answer this question. Um, really take the time, go through the inventory card. If you have your answer already or you finish early, you can actually practice putting in this transaction, the 6th of Feb, the sale. Practice putting that into the inventory card. But yeah, I'll give you 4 minutes. Okay, so the answer is $10 per shirt, and this is because we assume that the inventory that was purchased first is sold first. So we have to choose the oldest cost price on hand as the cost price for this sale. And in this case, the oldest cost price on hand is $10 per shirt. You also